Great. So thank you so much for coming out tonight. It's a pleasure to meet all of you. I had a great chance to network with those of you that were online. And so it's a great variety of people tonight. And hopefully I do all of this build up some justice. Um, and so I am going to talk tonight a little bit about economics. Hopefully I won't put you to sleep. But mostly what I want to talk about are some ideas that I have about opportunities to invest in this market, because one of my beliefs, one of my core beliefs after, it's been 25, 26 years of investing now, one of my core beliefs is there is a deal to do in every market. There are plenty of deals to do. So if you're sitting on the sidelines waiting for the economics to change to do a deal, that's the wrong idea, in my opinion. There's always a way to make money, always a deal to do. I think right now is one of the most exciting and nerve-wracking times that we've seen in our economy, because there is just so many things that could happen. And there's a lot going on, a lot of moving parts. We've had such a great run up. And so I think a lot of people in my world are asking me, when does the party end and when does the punch bowl get taken away? And so I'm going to talk a little bit about that tonight. But again, remember, if you buy right, there's always a way to make money in any market. So keep that in mind. This is my keeping my lawyer happy slide. And I'll get my slides to Christina. So if you don't get if you don't catch every single chart or every single thing, don't worry about it. I'll get my slides to Christina, and she has a process and, can post those or what have you. But I do have a degree in economics. Never thought I would use it because I mortgage, and, who in the heck uses their degree? Anyways, I did go to UC Santa Barbara, started my career in lending, and I was a mortgage originator from 1994 and gave up my mortgage origination license a few years ago. I went into multifamily brokerage. I'm a licensed California broker. In 2012, I went into multifamily and did quite well there. And again, as Christina mentioned, my husband and I own a few different companies that invest in non-performing notes. And mostly what we do is we work those loans out with the investors that haven't paid, or the borrowers that haven't paid in several years. And we try to keep people in their houses. And so we feel good about that. It's a great business. It's a little tight right now. It's not something that I would recommend that somebody who's brand new to the business try to get into. I would say get started on something that you actually own, the real estate. But if you've been in the business for a long time and you want to learn a bit more about residential note investing, then you can look me up. I have been speaking for quite a while. I do miss being in front of the room, contrary to tonight. I know I didn't make the drive to Pasadena, but I'll tell you a little bit about why that is. I've been on some different panels, some top producing multifamily panels. I've presented in front of the room. I've opened for Bruce Norris, which is kind of a real honor. I consider that an honor because he is one of my mentors. And I just love speaking and I love sharing. And real estate's been so good to us in our family. So again, we did start investing at a pretty young age, 25, 26 years ago. In real estate investing, I don't really know anyone who's successful who does it because they like collecting properties. I think people invest in real estate because they want the lifestyle. And it has given me that. And just a couple of personal things that real estate investing has added to my life. It's given me the opportunity and the financial freedom to contribute to my family in a significant way. And on the left, you can see my dad and my stepmom, and in between are these beautiful angel men who delivered a trailer to them in Paradise, California, after their house burnt down a couple years ago. And I was able to help them and help make that happen. And happy to say that we have visited them in their brand new house, which you can see on the right. And there is my dad coaching my daughter for her science fair project. And I homeschool my daughter by choice. I think that I have this amazing opportunity to impact her life. And there's really no job that I would like more than to be a mom to her. So real estate investing has allowed me to do that. And I'm so grateful. My mom in the middle there who has dementia. And 5 years ago, I was driving to San Diego 3 times a week from Orange County to care for her. And now she's much closer. But again, real estate investing, it's not about the dollars in the bank. It's about what that cash flow allows me to do in my life. And so for anyone who is just getting involved in investing, if you're wondering about that, is this a good thing to do? Yes, absolutely it is. Because to me, the real thing that's important is creating that liberty. And my company is Liberty Real Estate Network. And I just feel so strongly about that. And it's given us the opportunity to really bypass a lot of this drama that's gone on the last couple of years, because we can work from home. We work from anywhere in the country that we want to be. If we want to be on Maui on vacation, we just pick up and we go. So there's that. What do we know? What do we need to know to take action today? So why do we even look at economics? I have a lot of flippers in my world and a lot of experienced real estate investors. And they're like, oh, Kathleen, that's really great. You put on these presentations, but who really cares? I make money because I know how to do deals on my block, in my little town, in my little area. And why do I need to understand what the broader economics are? I just know how to go out and talk to people and make money. And that's great if you're that experienced and you have a territory that you've developed and you know that market area so well that you can just sense, like, you just understand when it's a good time to do a deal and when it's not, right? If you know how to recognize a deal. But for the rest of us, we need to build a framework. We need to have an understanding and a feeling for where the economy is going so that we understand and we can learn when is a deal and when is it not a deal. So tonight I wanted to share with you how I build my framework and just some details about the market. And then at the end of my presentation, I have 5 areas where I think there are incredible opportunities to make money in today's market and even tomorrow's market. So how likely is it that our seller's market is going to continue? I'm going to talk about that tonight. And then under what circumstances will I personally transact? Like, what are the things that I see that are really exciting to me? Now, I'm not going to spend a lot of time on this chart, so take a picture of it or do whatever you have to do. But this is the market cycle. Now, different aspects or different parts of real estate are in different parts of the real estate cycle at different times. What do I mean? Well, single family homes may be at close to a peak right now, but industrial may have a long way to go, right? Multifamily, where is that in the market cycle? So if you're picking a variety, like 31 flavors, right? There's 50 different kinds of real estate asset classes. You have to pick which one and then figure out where it is in the country and what part of the market cycle is that part of real estate in before you can understand where the opportunities are. So if you don't already know about the real estate cycle, if you haven't looked at a chart like this or learned about it, you should probably Google this. This was off of Bigger Pockets. That's free. You can just go to Bigger Pockets. You can Google real estate cycle. You can find this a lot of different places, but you might want to understand how real estate cycles work. In the long run, real estate has appreciated in value. So even if you buy at the peak, as long as you buy right and you hang on long enough, you're going to survive the cycle if you have a downturn. So even if you're scared, if you're sitting there going, gosh, I'm just so frightened to get into a deal right now because I think that things could tank, as long as you buy the property correctly and hold it for stability and for continuity, you can ride out any cycle that might happen in valuation. So just, you got to get over that fear and take action. That's what tonight's really about. If you are one of those analytical types like I am, and you like to read and learn about things, I can't really think of a better book to pick up other than maybe Kiyosaki's Rich Dad, Poor Dad. But once you get through that one, then you should probably pick up Mastering the Market Cycle by Howard Marks. And Howard Marks is a big bond trader. He's a debt trader. He's been in the business for a very long time, and he manages $120 billion in debt investments. So kind of a cool guy. If you don't like to read, as Bill Tan reminded me in January when I spoke to his club, not everybody likes to read. Look up his podcast because it's pretty good and you'll get the flavor. So anyways, this is a great book. I highly recommend that you pick it up. So what's happening? Why is it happening? Is it likely to continue? And what are the 5 disruptors? So then take action. Of course, I'm always about action, 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 action. So what's happening right now? Okay, well, in 2021, it's no secret, prices took off. Why? Why did they take off? So these are the questions I asked myself. Well, we had a decade of underbuilding. Have we caught up? Yes or no? We'll look at some data on that. The Fed has been buying mortgage-backed securities, which are the underlying assets for mortgages, and that has kept our rates extremely low. They're talking about stopping doing that or tapering the number of bonds that they buy on a monthly basis, but they haven't done anything except talk about it yet. Even so, rates have started to go up. So should we panic or what? So I have some more data about that for you. What about all those loans that went into forbearance? Are they going to cause the real estate market to crash? I've got some good news for you on that one. Well, you could say it's good news or bad news, depending on your perspective. But we'll talk about where are those loans in the process and how many of them do we think are going to actually convert to foreclosures? Is that an opportunity? Yes or no? And then we'll talk a little bit more about Wall Street and how that is putting a floor under the real estate market and government stimulus. So, and again, the government has been helping us as real estate investors. They've been increasing the loan limits on Fannie Mae and Freddie Mac and FHA loans, making it possible for that appreciation to continue with the low interest rates and not have to go into the jumbo loan category for home buyers. So if you're flipping, you definitely want to understand where those loan limits are, because that could dictate if you're going to back into how much you're going to put into a property, and you want to have the widest range of buyers in a market where the buyer has more control. You'll definitely want to know where those loan limits are so that you understand who's going to be able to buy your house and under what circumstances. Now, there's a lot of charts on this page, but basically you can go to this, basically just came from FHFA, and they're talking about different regions of the country and how much have home prices increased over the last November to November. So you can see in certain parts, the dotted line is the national average appreciation, which is at 17.5% nationwide last year. That's just crazy. Don't expect that to continue. That's an outlier, as we say in statistics. However, you can see different parts of the country did better than the average and some did worse than the average. So if you're looking to buy out of state, you definitely want to drill down into the appreciation rates and what's driving those in each of the markets that you might be interested in. And we all know that housing has been on fire. So I just thought I'd show you some of the numbers. Why is housing on fire? Well, a big part of the reason is that inventory is so low. So Black Knight is a huge aggregator of data. If you don't already look at their monthly mortgage reports, you probably ought to look them up. blackknightinc.com, I think it is. And they give you so many statistics and so much information and break it all down. The shortage of homes listed for sale is just phenomenal. So we're down 54% from 2019 on inventory. In Orange County, California, a typical inventory for us would be 6,000 homes on the market. That's kind of a balanced market in our area here in Orange County. We have 1,100 houses on the market right now. So hard to overstate the limit in inventory. I think flippers are frustrated. It's hard to find deals. everybody across the board in real estate it is a little bit tough to find deals right now. That's why you have to get really good at talking to people, knocking on doors, building that network like you're doing tonight. You got to get to know all kinds of people, bankruptcy attorneys, trustees for trustee sales, lots of realtors. You just need to look at all kinds of different divorce attorneys, family law attorneys. You need to network with all these people to find where the distress is, because it's definitely hiding right now. Residential rents grew in 2021. So we saw single family rents increase dramatically. We also saw apartment rents increase dramatically. So if you want to monitor how rents are doing, I highly recommend you go to yardimatrix.com. Yardi Matrix started to track single family home rents just this last year, because a lot of Wall Street institutional buyers got into the market, and they are using professional property management. And those professional property managers are providing the data to Yardi Matrix. So before Wall Street got involved in single family home rentals, it was really a lot of mom and pops and individual property management companies, and the data was very difficult to track. So with bringing in the Wall Street folks, we're starting to see more data on rent growth, which is just amazing, right? To see what the rent growth is. So if you're worried about valuations, remember that it's not just what the price tag is. If you talk to the folks that are in the audience there tonight about apartment purchasing, it's all about your net operating income, because you really want to keep track of those cap rates versus what you're paying on loans or what your rate of return is. And as rents go up, your net operating income goes up, and then your returns go up, and you could pay more for the building. So that's what drives valuation in apartments. CoStar is reporting that commercial real estate has also recovered. So one of the big things that we were looking for during the COVID pandemic was a commercial crash, where maybe we could buy some debt or buy some distressed commercial property, but that never really materialized. The banks held on to the loans that weren't performing, and they worked those out, or they put them into their balance sheet, and they just held on to a lot of them. The one area that is still suffering is office, where you have a delinquency rate of 12.5%, or a vacancy rate of 12.5%. Even multifamily, industrial, even retail vacancy rates are at 4.7% on commercial property. So as we see the economy slow down, we might see more distress in the retail space. So if you're a commercial real estate investor and you're looking for opportunities, you might look in that retail space, converting that to a different use. So that's just one of the things that you might look for opportunities next year. But foreign investment, surprisingly, has come back to our commercial real estate market. So for all those people that, hear that, well, the United States isn't the investment that it used to be, I kind of disagree. I think that foreigners are still looking at the United States and our economy as the best dirty shirt in the closet, so to speak. It's not perfect and it's not great maybe, but it's better than the EU. It's better than China, which of course we know what's going on with the commercial real estate in China. And so we did see an influx or a return to 2019 levels for commercial real estate investment in the US in 2021. So I'm expecting that to continue, even with rising rates and even with perhaps an economic slowdown on our horizon. So it's no surprise to anyone here in the audience that inflation is here. Producer price index and the consumer price index are both increasing. I think we had the biggest consumer price index reading at 7.5 last month that we've had in 40 years. So the Fed was first telling us that this was all just kind of going to come and go because of COVID and all the money that was flowing through for COVID. But actually it's been a little bit stickier than that. So we're seeing that cost of goods, which is the producer price index, The cost to make goods and the cost to buy goods have both increased, and we're getting close to that 10% level. So this is driving a lot of the conversation about rates going up and about the Fed trying to slow the economy down and get the inflation under control. However, the Fed is having a hard time doing that with just talking. So the question is, in March, when they meet again, are they actually going to raise rates? One of the things that's driving the inflation is oil prices. So when the Biden government came into power, one of the very first things that they did was put a halt to any of the oil production in the leased land. And in fact, they haven't authorized any new oil leases since they came into power. So, and the new restrictions that they're putting on fracking and drilling is driving oil prices higher. So whereas we had a $40, $47 oil per barrel oil price when Biden came into power, we're getting closer to 100. We're right about $90 a barrel. Right now it's fluctuating, but when we get to $100, that is a significant benchmark. And I think that could really scare the Fed into taking some more significant action, because petroleum goes into a lot more than just gasoline. In fact, it drives a lot of the prices on what it costs us to build a house. So as real estate investors, especially if we're flipping, if we're doing any kind of improvements, if we're doing ground up construction, we definitely want to keep an eye on what's going on with oil prices and how likely is that trend to continue one way or the other, because it definitely fuels the inflationary pressures. And this is one of the reasons why we have our 10% inflation that we're seeing, is because our oil prices are so high. Now, the good news is that could be reversed. If they just started drilling a little bit more oil or released some of those leases back into production, we could actually reverse that fairly quickly by lowering the oil prices. So, that I think is the good news right now. The government is holding those prices higher because they care a little bit more about reducing the emissions, and they have that green agenda. And so I'm not taking a position on the agenda. I'm just mentioning that is why we're having some of the inflation that we're having. A big part of that is heating oil and oil products that go into our building materials. One of the other issues, I think Alex was mentioning earlier tonight, is about all those ships sitting off of the coast of Long Beach. And here's a photo for you. So if you're not in the Long Beach area, or you don't get to the coast that often, being from Pasadena, maybe you haven't seen this, but the shipping container ships are just stacked up like little dominoes out there. They're just sitting out there waiting to unload. And some of the regulations in California, AB 5, which we passed a couple years ago, getting rid of the independent contractors, turned all of our truck drivers into W-2 employees. We have very strict regulations on environmental controls on trucks in California. We also have very tight restrictions on who can go, what kind of trucks can go into the port. And because of all of that, it slowed a lot of the unloading of the ships down. And we have a backlog. So as a country, we're short 80,000 drivers. And we have a huge pushback from truck drivers against vaccine mandates. So this has caused our freight rates to skyrocket. And this is also driving inflation. Now, it is also true that this type of inflation could be turned around fairly quickly, not immediately, but fairly quickly, if there was an incentive to do so from the government. So there's a couple of things. So some of the inflation that we're seeing is sticky. It's going to stick around no matter what. Some of the inflation that we're seeing is still what I would call transitory, but it's more transitory because the government is moving us in that direction. The government is choosing environment over the lower inflation rates. So just be aware that there are choices there, and that choice could be changed, and that could change some of that inflation. So if you're betting on inflation to buy real estate, and you're only buying real estate as a hedge against inflation, you might want to just keep an eye on those things. And from John Burns, our good friends at John Burns, we have some of the components that go into building a house and how much those components have gone up year over year as of the third quarter of last year. So lumber is one of the big ones. We know that lumber prices went up significantly and now have moderated a little bit, but then have gone back up. But now I'm hearing things about delays in garage doors and all kinds of appliances. And I saw one number from John Burns Real Estate actually recently saying that the inflationary pressures have added $19,000 to the cost of building a single family home. So just inflation alone is adding that much to the price of a house. Now in California, it may be higher than that because everything costs more here, but that's kind of where we're at. Even with all of that, builders are bullish on the economy. They're bullish. This is a chart showing permits. Building permits and starts is a good look into the future for the housing market. And we can see that builders have continued to be very aggressive and they're bullish. The starts are up 75. The starts are up significantly, but they're only 75% of what we were building in 2005. So some people are saying that they are concerned that we're overbuilding. But I would tend to say that no, we're not overbuilding. We're still only building 75% of the amount of units that we were building in 2005. And of course, we overbuilt in 2005, and that was one of the things that contributed to the market corrections in 2008. But while the builders are bullish, the consumers are not. So the consumer sentiment index is lower, and we can see that it's quite lower. So even though Wall Street's doing pretty good, the builders are very bullish. Wall Street is buying a lot of the new homes that they're building. The consumer is still struggling. And as prices increase and as we have all of this inflation, consumers are turning negative on their sentiment. So we want to keep an eye on this because, obviously we want to know that we are going to have a buyer if we're doing a flip, or we're going to take a chance to build an ADU, or we're going to get involved in a construction project. We want to know that there's going to be a buyer at the other end of that spectrum to buy that property from us. On the other side of that, though, is if you're getting into multifamily, if consumer sentiment gets low and the buyers, people that are forming households, if they stop buying new houses, they're going to be renters for you. So again, there's always a way to do a deal in real estate. It's just a matter of which side of the table do you want to be on? Do you want to be in the multifamily side, or do you want to be developing new single family? And one of the things that is concerning me is the real wages. So wages are growing, but they're definitely not keeping up with inflation. And so when you look at inflation adjusted wages, which is what this chart is doing, it's taking the increase in payrolls, in wages, and it's subtracting out that 7.5 CPI, right? So you can see that wages are going up about 5%. However, when you control for the 7.5% inflation, you can see that people's buying powers are disintegrating, and people are aware of that. They understand that it's costing more for milk and bread and gas and all those other things. So now getting into a little bit more of what do we think that the economy is going. One of the things that I look at is what's happening with manufacturing. So this is a chart showing the ISM, which is a survey of manufacturers, and it's an index. The CPI is the inflation rate year over year, or consumer price index, and that's the blue line still going up. Usually these two metrics move together. So right now we have kind of an unusual situation where manufacturing is decreasing or contracting, but CPI is still going up. So when you have an ISM that turns downward, that usually tells you that the economy is slowing down. So will the CPI turn downward? Will inflation turn downward? My thing is that until we get some relief with oil prices, I don't think we're going to see a relief in the inflation rate. I think that oil prices and heating oil and all kinds of different oil products are still driving an inflationary rate, even if manufacturing slows down. But it will lag, and eventually the inflation will turn down once the consumers stop buying as many products. And the Atlanta Fed tends to agree. So if you want to watch a blow by blow of where we think the GDP or the growth is in the economy, you can go to the Atlanta Fed. They have a great metric called GDP Now, and you can just Google Atlanta GDP Now. And they keep track based on when each economic report comes out where they think economic growth is. And whereas we had economic growth in the 6% range last year, the first quarter of this year, we're only showing a 1.3% GDP growth rate. So the economy is slowing down, and that will eventually slow down the consumer price index as people stop purchasing. So the economy is slowing down, but inflation is getting higher. So that is kind of a quandary for the Federal Reserve Board, right? And one of the big questions in real estate investing is, where will rates go? What's going to happen with interest rates? We've already seen them start to go up. And one of the things that is driving that is that some of the market participants have priced in already 5 to 7 25 basis point increases in the federal funds rate from the Fed. Some people believe that they're only going to be able to do 1 or 2 rate hikes, and then they'll have to be done because they're going to drive the economy. The GDP is going to go down into a recessionary level. So I tend to be in that second camp. So whereas I'm expecting in March the Fed to raise rates 25 to 50 basis points, I don't think that they'll be able to sustain a long-term increase in interest rates because the government owes too much money, number one. And number two, they're going to drive us into a recession, which they really don't want to do because they want to keep employment strong. So I think that they're going to allow the inflation rate to keep going a little bit stronger. And the pressure will be on to see if we can get our government to increase production in oil, or if we just learn to live with that higher rate inflation rate. So we'll see what happens. And when an economy turns down and we turn into a recessionary type of a period, we definitely do see that inflation should turn down. However, if we continue to push gas prices and oil prices higher, and we don't fix our supply chain issues, we could see inflation persist for quite a while, which is a bad situation, which we call stagflation. So again, here's another chart that just shows the amount of debt, the blue line that the government's in. The other reason that the government can't really sustain, or the Fed can't really sustain, a much higher federal funds rate is because our government owes so much debt that a large percentage of our budget already goes to debt service. And when the government has to turn over that debt at a higher interest rate, and even they have to raise more money out of that budget to pay for the debt service. Just like if you have an adjustable rate loan on your mortgage, on your house, or your credit card, when rates go up, you pay more in interest, and that has to come from somewhere. And in a recessionary type of environment, or if the Fed is pushing the economy and economic growth slower, tax receipts only get smaller. So this is kind of one of the risks that we can see it coming in our economic environment in the macro level, that the Fed could lose control over this inflation. Now, the good news for real estate investors is that in an inflationary type of environment, that's really great for real estate. Real estate is a great asset to hold when there is inflation because rents will increase. And if you have a fixed rate mortgage, your payment is fixed on that property, and your valuation should improve. So, so holding real estate in an inflationary environment is a good thing. So this is an indication to me that it could be still be a good time to buy, because I personally don't think the Fed is going to be able to control inflation with 1 or 2 rate increases. I don't think that's going to be enough to control it, because I don't think that's what's causing it. I think what's causing it is the lack of allowing our oil industry to drill because of environmental programs and the green movement, and also the lack of will to release the truckers and to improve the regulations or release the regulations even temporarily to get the country's products moving faster. I can see all those ships sitting off of the coastline and all those products. And because of the shortages, we have price increases, and that is being reflected in the price of housing. So is it likely to continue? So I want to take a deep breath here now, because I've given you a lot of information, but I want to say a couple things. First of all, I don't think the sky is falling. Even if we have inflation that runs a little hot, that's actually good for real estate, especially if you already own real estate. And the Fed not being able to raise rates is actually also good for real estate. Yes, we might see a period where we get 4.5% or even a 5% interest rate, and that could slow down the appreciation. But we had 18% appreciation last year. So if we slow down to 5% appreciation, is that a bad thing? It's not the end of the world. So I am still really bullish on real estate. I think that it's still a great time to buy. And now I want to answer a few questions that I hear a lot about REOs and foreclosures. So one of the things that I have been known for, that I started tracking really early, was the forbearance program that Fannie, Freddie, and FHA put into place during COVID. Because right when COVID first started and they started shutting everything down, many people in the real estate economic business, or, a lot of the gurus, started to say the real estate prices were going to crash because we were going to have a wave of REOs. I never quite bought into that narrative. And here's why. The government this time around, different than 2008, the government decided to put a floor under our real estate market. And I think that the government, even if we turn into another recession and people start to struggle, I think that the government has an incentive vis-a-vis Wall Street to keep a floor under our mortgages. So I believe that if we go into another recession and we have another period where we have some economic pain, they have seen that this forbearance program that they used during COVID was so successful. I see that they would be likely to use it again. So that's my hypothesis. Now, that's just my hypothesis. It hasn't been tested yet, except that you can see the results of what happened in the COVID period forbearances. So let's talk about that for just a minute. We peaked with a 7.6 million loans in forbearance. That's a lot of loans, folks. Out of that, 550,000 loans, only 550,000 loans are still in loss mitigation. So majority of the loans that are in loss mit are from pre-COVID times. And the majority of those are an FHA loan, which are low down payment and lower credit quality. These loans are not hitting the market. These houses are not turning into foreclosures. Why is that? They're being sold off to big hedge funds on Wall Street as non-performing loans. And I can tell you this from experience. So they're just not hitting the inventory, and I don't expect them to in the future. In fact, delinquency rates on mortgages have hit an almost all-time low, 3.38%. It's crazy. 2000 to 2005, before the crash, the average was 4.84. So I like to say that pigs are flying because we had a government program that actually worked. So the active number of loans in foreclosure fell to 128,000 last month. And that is an all-time low. It's only 0.25% of active mortgages. That's the lowest rate since they started tracking in 2000. So even though the foreclosure moratoria have expired, the starts of foreclosures now, it says it's up 10.8%. Well, that's only 4,100 transactions. So you have to keep an eye on the difference between the percentage change and the number change, right? So keep an eye on this as a savvy investor. don't get fooled into thinking there's a lot of foreclosures because they're up 10.8%. Because if you go from 1 to 2, that's 100% increase, right? So just keep that in mind as you're looking at statistics that come out in the media. Lending standards are the tightest that they've been in decades, and they will probably continue to be, and if we go into a recession, they will get even tighter. So don't think that we're going to have this wave of foreclosures of people losing their houses because they overbought. This is not the standard that we have used this time around. In the last 4 years, we haven't been building the same kind of inventory as we had in 2007 to 2010. So the 4 years of the housing crash, the supply of homes was 9, 7, 8, 9 months of supply. Right now we're at 1.8 months of supply. So even if our supply doubled, it wouldn't even be close to being a buyer's market. The foreclosure situation, as I mentioned, is much different now. In 2007 to 2010, we were looking at new foreclosures of upwards of 2 million. Now we're at 38,000. So this is just really not anywhere close to where we were. If you want some more data on what loans are going into forbearance and into foreclosure, you should definitely go to Black Knight. They put out a report once a month and they break it down. They even break it down by state and even by MSA, which is the statistical area that FHA uses. And so you can see, though, there's still $154 billion worth of loans that are in forbearance, 835,000 loans. But the share of loans as a percentage of the marketplace is very, very low. And Fannie and Freddie, so the FHA loans, those are the ones that have the least amount of equity. And you can see the other category here are jumbo loans. If you're interested in watching this, you can see that they're going to roll off. The peak of the roll-offs of forbearances is going to be in March of this year. So we're almost to that level. And we really haven't seen foreclosures go up dramatically at all. One of the reasons that this is different this time is that we have so much equity in our homes. So $9.8 trillion worth of tappable equity, that's up to an 80% CLTV. So there's even 20% more equity on top of that people have nationwide. And you can see the difference between 2010, where we hit the bottom of 2.3 trillion in equity. That's just how much equity people have in their homes. Now, that doesn't mean there isn't distress out there. There will be distress. There'll be distress situations. It's just you're not going to see the kind of distress that you did see in 2009. And one illustration of this that I'll just touch on this briefly, but Freddie Mac did sell off a pool of non-performing loans. So for your note investors out there, if you are looking to buy a loan that hasn't had a payment made on it in, say, a year or two, are you willing to pay 100% of the balance of that loan? Probably not, right? I mean, that would not be a prudent thing to do. Well, Freddie Mac just sold 4 pools totaling $1.2 billion of non-performing firsts to 3 investors who paid in the 100% range of unpaid principal balance. That's crazy to me as a note investor, but this is telling you how much confidence Wall Street and hedge funds have in the real estate market. They wouldn't be paying 100% of UPB for a non-performing loan if they didn't think that they could convert those properties into liquid cash by foreclosing or doing workouts with the borrowers and then selling those loans off. It's just, this is really phenomenal to me, but it tells us where we are in the marketplace. So I still see a lot of strength in the real estate market. Now, affordability is getting stressed. So we're not to where we were in 2004 and 2005. Okay. So the payment to income ratio peaked at 34% in 2005. We're still at 22.4, but that was with an interest rate at 3.1. And as most of you know, we're about 1% higher than that now. But FHA loan limits are going up. And so we need to watch that. But compared to where we were in 2007, the houses in the country are still more affordable than they were in 2007. We're still under where we were in a normal lending standard. So if you're an originator in the mortgage market, or if you've gotten a loan, you might understand that lending standards is about 28% of your gross income before taxes should be used for your housing payment. We're at 25.8 right now. Again, rates are going up. This is because people are thinking that the Fed is going to raise the discount rate, and they're raising rates in anticipation of that. So here's a little tidbit. If you're thinking about getting into a transaction and you're going to do a loan, the highest interest rates were always right before the Fed meeting. So because you have a lot of people betting in the marketplace for those mortgage-backed securities, that the interest rates are actually going to go up more than what the Fed actually does. So there's a lot of people betting right now that the Fed's going to go a half point higher, but it would be more consistent with the Fed to go a quarter and then maybe taper off and buy less mortgage-backed securities. So, this is probably not going to get much worse unless the Fed goes more than 0.5% higher. If they go a full percent over the next 6 months, then we could see interest rates go to 4.5. I don't think it really hits the buyers that hard until we get to closer to 5% on a 30-year fixed rate loan. I don't think you see the confidence or the negativity or the psychology really turn until you get closer to that 5% number. But affordability also includes how much do you have to spend on groceries and gasoline, and other expenses are going up higher. So we do have to temper that a little bit. I do think rents are continuing to grow. This was an interesting chart, and I'll take you back to Yardi Matrix now again and tell you, hey, go look at Yardi Matrix for all of their reports. There's so much free information out there. But they did a study really recently at a company called RealPage, which is also a data provider, on the difference between the increase in rents in coastal gateway cities and metros like LA, Orange County, San Francisco, other East Coast gateway coastal communities versus the Sun Belt. And the Sun Belt is still only having rent appreciation about 50% of what the coastal gateways are increasing. So you can see that rents were increasing about 30% versus a 60% increase in the coastal markets. All right, so I've talked already about the Fed. They added a lot to their balance sheet. They're probably just going to taper and then increase the discount rate a quarter to a half. I don't think they can do a lot more than that without pushing us over into a recession. So that's why I'm saying I don't think that the Fed's going to raise more than that. The 10-year Treasury is a really good thing to watch. It recently went from 1.5 up to 2, which really indicates that's that 0.5 point getting baked into the cake already. So that's why we've seen interest rates go up 0.5%, because that's what the market is expecting the Fed to do. So now I'm going to shift gears in the time that I have left here and talk about opportunities, because I think there's a ton of opportunity in the marketplace. And there's always ways to make money in real estate, even in a rising interest rate environment, because number one, the government has decided that they're going to pick winners and losers more so than I've ever seen in the 25, 26 years that I've been involved in lending. The government programs and the money that's out there to help investors build housing and support low-cost housing is really phenomenal. So I think there's a lot of opportunity if you're willing to dig into the regulations. So what you need to understand is, what are the policy objectives of the government, and look at the tax code changes. And there's a ton of cash in the infrastructure bill that they passed. So you need to look into that and see where you can tap into that really cheap money and go with what the government, don't fight the government, don't fight the Fed, as they say. But if you go with what the government is sponsoring, or incentivizing, I think there's a lot of opportunity there. Be careful because courts are ignoring constitutional contract law and property rights. So if you're a multifamily investor, you want to go into it with an expert with your eyes wide open, because as some of the people that were sharing earlier on the networking, if you get a bad tenant, it could be a long time before you collect rent. So be careful with that. Fed action and overreaction. So I talked a lot about the Fed. Can they control inflation? I don't think so. Will they support the stock market? I don't think so. I do think they will support the housing market. I think they're going to let stocks take a correction, which they probably will do if they go 0.5% in March. And we'll probably see a buying opportunity. How can you get involved in real estate in the stock market? Well, you might want to invest in a REIT. And if the Fed takes significant action in March, the REITs that are real estate investment trusts that are traded on the open market, they might take a dip. So that could be an interesting opportunity in the short term. Consumer confidence. So as people start to lose their job in a recession, as inflation continues to grow, there will be distressed situations in real estate. So some people, not across the board, not enough to cause a foreclosure wave, but some people on an individual level will have distress. And as real estate investors, if we can go in and solve problems for people who have challenges, that is an opportunity for us, not to take advantage, but to solve a problem. There's tons of people out there that can teach you to do this. Bill Tan is on the call tonight, teaches excellent courses on creative financing, creative deal structuring. You should really look those courses up because I think you'll have a chance to use some of those skills in the market that's coming. So mandates, moratorium, the rule of law, are we going to have all those things? As we start to see people fight back against all of these things, it will cause disruption in the economy. There's going to be a truckers convoy that's going to start from Barstow and go across the United States to Washington, D.C. You're going to see a lot about it in the media, and it could further disrupt supply chains. Depends on how many people take part in it, but they're starting a week from today on the 23rd of February. So keep your eye on consumer confidence, because the more conflict there is, the more shaken people get. It might shake some of those listings or people that want to move out of their real estate. It might shake those transactions loose. Technology, I have a couple slides on that, and global agendas. So I talked a lot about disruption in government. Huge opportunity in California right now with rezoning, right? The governor signed 31 new laws last year into new initiatives into law. You should look this up. A lot of changes about how many units you can put on a lot, on a single family lot. ADUs, they're forcing the local governments to be more friendly about additional dwelling units to build more low-cost housing. The government wants it. They're paving the way for you, folks. So if you don't know about ADUs, you probably want to learn about those. We have a great friend named Christy Sirtwell. You can look her up. She knows a lot about that. Christina Suter knows a lot about that. So talk to these folks and find out and make those connections, because there's lots of opportunity to make money on that. Supply chain onshoring. Okay, so if you're in commercial real estate, I would be looking at the ports on the South and the East Coast who have friendlier governments, who don't have as much of emission standards on trucking, because it's getting to the point in California where a lot of those ships that have been sitting off of there is economically feasible for them to go all the way to Houston or all the way to the East Coast to unload. So you might want to take a look at real estate, industrial real estate, warehouse real estate, rental property, because as those ports expand, there will be more workers, longshoremen. So longshoremen make good money, by the way. There would be buying opportunities or development opportunities in those markets. More storage for goods and more storage for containers close to the ports. We are going to be onshoring our manufacturing again, manufacturing opportunities. So if you're in the commercial realm or you want to deal with that, you can look for opportunities there. I talked about consumer and home builder confidence. I think the reason that home builder confidence is still super strong, whereas consumer confidence is faltering, is because the home builders have a backstop with the Wall Street buyers. These build to rent transactions are growing. Many of the major home builders are getting into the build to rent, and they don't have to be subject to individual buyers because they're selling out an entire tract all to one group. So even though home builders may be a little bit more confident, our consumers may falter a little bit. And I just already talked about the spike. We may have a short spike in REOs. I don't know. I actually think we might not. But if we do, even if we have, even if we go from 38,000 foreclosures to 70,000 foreclosures, that's almost double, right? And the press isn't going to tell you that we went from 38,000 to 70,000. They're just going to say that the number more than doubled. We're up over 100% foreclosures. Well, Johnny on the street isn't going to do the due diligence to understand that that was only another 38 or 35,000 transactions. They don't understand that. They're just going to look at the headline that it's over 100% higher, and they're going to go, oh, it's not a good time to buy. Maybe I ought to sell. Or, it can create uncertainty in the marketplace with buyers. So keep an eye on this, because again, anytime there's a change in the consciousness like this, there's opportunities in the marketplace. Technology. Now, I know I have 5 minutes. Okay. So I'm just going to go quickly through this, but this is totally worth talking about. Technology is a game changer, and we have some technology coming along that is really could change numbers for us on how much it costs us to build a house. In the short term, this could create a profit, a windfall profit opportunity for builders that get involved in the 3D printing space. So there's a tract in the Rancho Mirage area of 3-bedroom, 2-bath houses that are, 1,450 square feet for $595, and they're 3D printed with a pool. You can see the picture, right? So if I'm building in an area where everyone else is doing stick building and they're selling their product, say for 600,000, but I can build a similar quality product, but it only costs me 300,000. Do I have the opportunity to make a windfall profit? Yes, I do. How long do I have that opportunity? Until 3 other builders or 2 other builders in the community start building the same way at the same price point. And then we have a gas station on every corner kind of situation, right? Where we start competing with each other, and it brings the overall cost of a housing down. So in the case of factory built and 3D printing, I think that there's a short term, maybe a few years opportunity to get involved in this kind of production. So I think it's an excellent thing to look into, especially if you're in the building business and you're so inclined. Now I'm going to talk a little bit about blockchain, so don't freak out, right? But there is a group in Florida that is using blockchain for part of their syndication. And I wanted to kind of give you an idea of how this could work for syndicators to open up a lot of money for apartment syndications. So right now, the SEC hasn't ruled on if you can sell an apartment building by selling NFTs or through the blockchain, right? So how would I do this? Let's say I'm going to buy this building that's in the picture, and I wanted to raise money by selling coins. What I would do is I would buy the property. I would then create a coin or a digital asset that I could sell that is secured or backed by the business that owns the property, right? Just like if you were going to subscribe in a Reg D syndication and you're going to have a memorandum of a Reg D offering, and you were going to get membership units. only instead of membership units and a Reg D, you're going to get an NFT, right? A non-fungible token that is attached to this building. It is a certain amount or percentage ownership in this building. Well, there's this developer in Florida who is doing the standard route where they're selling their building using a Reg D offering, but then they're taking like 10% of the ownership units and they're creating a token around those membership units, and they're putting them with a broker. So if I have 5,000, let's say the minimum is 50,000 to get into the syndication, but I only have $5,000, but I think this is a great opportunity to buy into this building. Instead of going into the Reg D syndication, I could wait for the builder to post these on this brokerage platform, and I could go in and I could buy these, I could buy into this apartment building via a token on the blockchain. So what this has the opportunity now, this is in its infancy, okay? But if you're young and you have the time, or if you're old and you have the time, if you have the time to learn and educate yourself about this, I think this is an incredibly huge opportunity to create more liquidity for real estate investment from smaller investors. It's what we hoped crowdfunding would do, but it didn't quite make it. So I think this creates a secondary market where you have more liquidity in these types of investments, which has always been a barrier to entry. And so I'm super excited about this opportunity. I think this is going to open up just a huge platform. Now, the SEC is likely to rule about how these regulations are going to go forth sometime in 2022. So this is just in its infancy, but like I said, these are disruptors. So you have to be willing to dig in and get into the weeds and follow it for a while. Finally, I just want to touch on global narratives, because I think that the consciousness is starting to get to the point where people need to be aware of what is on the agenda for our government. And if you want to learn more about demographics and the economy and society, I think that you should look up this gentleman in the center of the picture. His name's Neil Howe. He wrote a book several years ago called The Fourth Turning. And you can either read the book called The Fourth Turning, or you can look up this YouTube video, which is a little easier for Bill, especially people that Bill knows that don't like to read. And but you should definitely look up this interview, because it is an hour, so it'll take some of your time, but it really explains where the demographics are going, and it will help you understand what's going on with our world a little bit. And so, you know, because there's a lot of forces that are going on kind of behind the scenes, and I don't know how aware people are of it, that really want to build into our economy this whole concept of carbon credits and putting the actual cost to the environment into our investments and everything that we do in our economy. So I have one more slide. This is the last one, I promise. But I think if you want to learn more about this global agenda, what you ought to do is look up this report from the World Economic Forum. All right. So the World Economic Forum is a group of government leaders, and the US included, Canada, all the major economic governments, and they meet in Davos, Switzerland, usually once a year, and they talk about what their goals are for the world economy. And out of that come these reports and these initiatives. And for a long time, I didn't really think it was that germane to the conversation in the United States, because it wasn't really touching our economy, and there wasn't the government will to get these things done. But what I see happening now, I think we need to be aware of it. And so, not to panic about it, but you should definitely make yourself aware of these things, because 10, 15 years down the line, this could definitely be the reality. So if you were wondering why Bill Gates, for instance, is the largest owner of farmland in the United States, this report will explain to you why he is the largest owner of farmland in the United States. Because what they're talking about is building into every investment, every property, every car, every business, the cost to the environment in the form of CO2. And they have a strategy, and there's actually a formula for how they're going to do this. And it's all outlined in this report. And so as you're looking to make real estate investments, not for the 2 to 5 year term, but the 10 to 15 to 30 year term for your kids, you definitely want to understand where this is going, because if it becomes a reality, it's definitely going to affect the value of your investments. So I'm just putting it on the table. They have a whole agenda for all of us for 2030 and 2050. And I think that you owe it to yourself to find out what that is. So how does that get costed in? And the good news for us now is if you're buying property now, you're not paying for this extra tax or this extra cost. So, another argument for getting into real estate now. But I definitely think you owe it to yourself to take a look at it, because you might make some different decisions about what you want to invest in based on what you read in this report. So if you're waiting for the universe to send you a sign to start investing, here it is. I give you permission. Go do it. And my recommended, finally, so find a way to buy under replacement cost. Okay. So costs are going up to build. Very rarely do they go down significantly. So if you can find a way to buy a property under replacement cost, go for it. Finance on friendly terms. So if you're getting into commercial, make sure you don't have personal guarantees involved, right? Talk to Karen, right? She was talking to you about from Trillion. She was talking to you about the fact that they don't have any personal guarantees. Perfect, right? Friendly terms, business people that are going to be willing to work things out with you. So that type of thing. Real estate is a hard asset, and it's a great hedge against inflation. So I am bullish on real estate, but I'm also pragmatic. And the people that lost money in the crash in 2008 were the ones that didn't have liquid reserves. So please, please, please keep a liquid reserve, because you never know when it's going to be a rainy day, and you definitely want to have those to lean on. And if things do correct in valuation, you want some cash to go out and buy more. So if you want to follow me on LinkedIn, Kathleen M. Kramer. I did put my email down there, but I check it a couple times a week. So I would probably recommend that you follow me on LinkedIn, and I check that more than my email these days. So that's it. So I'll take questions, and I'll thank you so much for your attention and your time.
Okay, let's give her a hand real quick, guys. Perfect. So we're going to go a little long tonight, because if you guys probably have some questions. So Alex, is there a question from the chat? Are you ready for that?
No,
No.
I don't think there is.
Okay. All right. Is there any questions here in the room? All right, in the back, Joe.
On the rezoning in California, can you ask her what those opportunities were? I know she mentioned ADU, but just ask her to go over those.
So rezoning, so Kathleen, the rezoning in California and ADU, what were some of the opportunities you saw there?
Okay, so the rezoning gives the opportunity in a single family neighborhood to build, depending on the situation and the setbacks and the lot sizes, anywhere from 2 to 4 units on a single family zoned lot. So what we've been seeing is this is driving up prices of houses on larger lots especially in Orange County, I think in LA County too. So the new regulations that came down from the state opened up or eased the regulations so that you can do garage conversions more easily. You have setbacks. It forces the cities to create a path so that you can get your permitting faster. And so, what they're trying to do is they're trying to create more density in our single family home tracts. Now, you may not agree with that. In fact, I don't want a bunch of high density in my neighborhood, right? Who does? However, dig into these things because there are a lot of opportunities there.
You mentioned that commercial is still not, it is slow to on the uptake, so it might be a good time to get into some commercial real estate and transition the use of it. Does she have any examples of that?
So Kathleen, Deborah Ravazzo is saying that you mentioned that commercial is still slow on the uptake at this moment, it's still lagging behind. Do you have any examples of that you're saying?
Of the transition.
Of the transition?
About changing the use of some commercial to be more accommodating. I know some people are doing office space to.
Yeah, commercial change of use. Are you seeing any examples of commercial change of use?
Well, personally, I haven't personally been involved in that kind of a transaction. I can tell you that I've seen just articles about it. But mostly what's happening is in some of the metro areas, you've got office space being converted to residential. And then I think in the next downturn, you'll also see a repurposing of even some retail locations, because now that some of the zoning is getting loosened up, you might be able to take in some of those commercial areas, take some of those tracks where you might have a small strip mall that is vacant. You might be able to tear that down and put up townhomes and that type of thing. Like even on Beach Boulevard in Orange County, we're seeing some of those old retail locations get torn down to the ground, and then they're putting up townhomes or small apartment complexes.
I know of a deal in in Tucson. There was going to be a hotel change of use from
Yeah.
going to multifamily. Alex, do you have any questions?
Yes, I will have Bill Tan unmute and ask his question.
Yeah.
Go Bill, go Bill.
It's just that I'd like her to, she mentioned basis points multiple times. I'd like her to explain that for people and how that would affect us. And then I have another question following that is, how about the repurposing of malls, shopping malls?
Repurposing of malls. So basis points. So I think everybody heard that, right? I don't need to repeat it. Okay, Kathleen, go ahead.
Okay, so so when the Fed increases the federal funds rate, what does that affect? That affects the discount rate and it affects the prime rate, which really only directly affects commercial lending, right? And credit cards and home equity lines of credit, if anybody still has one of those. It doesn't directly affect mortgage rates. It only pushes them. It only influences them. Now, a basis point is just one fraction of a percent. So 25 basis points is 0.25% in the interest rate, in the discount rate, 0.25%, right? So a basis point is just 1/100th of a percent. So if the Fed increases interest rates by 25 basis points, the interest rate that the Fed controls, which is the discount rate, goes up by 0.25% or 1/4. Did I answer that question?
Yes, Bill, you happy with that?
Very well. But
Okay. And Bill, you had a second half to your question.
how about the repurposing of shopping malls?
Oh, sure. I see that. We have a mall that's really close to us, the Westminster Mall, close to where I live in Orange County. And it is under plans for redeveloping. The challenge is that it's such a huge project because it's a shopping mall, right? And you still have some tenants in the mall. I mean, really what they ought to do is just raise the whole thing to the ground and then start over and put in a bunch of mixed use, right? With housing units and some retail and, restaurants and things like that. But I think it just takes a long time to repurpose a shopping mall because of the size, the dollars involved. And then of course you have all of the environmental requirements and restrictions with CEQA, especially California, right? So it can take years to repurpose a mall.
Years.
Mhm.
I was going to add in, what I've been seeing a lot of too are office buildings being converted into industrial. So you see
Yeah.
Amazon popping up all over the place. They're just taking large office buildings and then making them industrial warehouses.
Yeah, Boeing in Huntington Beach, Boeing sold 2 years ago, Boeing sold a big piece of land to Amazon, and it took them a year to take the building down. I think because it was Boeing and they were probably had some kind of chemical process going on there. And so they had to do all the environmental mediation, but now it's a big Amazon warehouse distribution center. Yeah, right.
Yeah, I know a deal in Massachusetts that I'm related to that was again a piece of land, and Amazon is looking to be able to build a center there as well. So yeah, and that's in the last 2 years. All right, here in the room, is there another question? John?
I noticed you said something about the rental market demand increasing. Do you foresee in certain classes of multifamily that prices will increase, building in production increase, so that can expand? And then my second question is, like, if you were to take California and Florida, what kind of differences and similarities would you see in appreciation versus depreciation? So like anticipating a crash, basically.
Okay, so I'm going to take your second question first. So between California and Florida, what are you seeing as far as appreciation versus rental increases? Is that what you're saying, John? A crash versus appreciation. Okay.
Well,
Does that make sense?
Yeah, I understand the question. I hate to kind of put it this way, but I think that both California and Florida are way too big to generalize about the state in general, right? So I think what we have seen is that coastal metro areas have recovered significantly, both in California and in Florida. As far as the future is concerned, I am a lot more bullish on the Florida market than I am on the California market. But with saying that, there's still a lot of people that want to live here. And what I would rather do is direct you to a resource where you could dig in by the actual local market and get those statistics for each particular market. And that would be Yardi Matrix. So if you go to yardimatrix.com, they publish statistical analysis based on professional property managers and what they're actually doing. And then also the National Multifamily Housing Association, they do a webinar once a month, and they have professional property managers on from different regions of the country talking about pricing in their markets, challenges in the market, and they also put out data. So those two resources are excellent for data in the multifamily space. And you could drill down into the particular market that you're interested in, or if you're more looking for hot markets, you can read through the reports and look for those markets with the biggest growth potential.
Okay, so Bill, did you have something you wanted to add to a question, or do you have a fresh question?
Not a question, it's an observation.
Okay, what's your observation?
Observation is in other parts of the country, they are taking hotels and motels that underperformed during our pandemic here and went under, and they're converting them to apartments and or affordable housing.
Mm-hmm.
I just was talking to earlier today to a group from St. Louis, Missouri, and they're in Illinois. They're seeing that right now.
Right.
Hey,
Thank you,
Bill.
Bill.
We have another question in
Oh,
our.
perfect. Hold on to a second for a second, Alex, because John actually, he had a first part of his question that I didn't repeat. So John, what was the first part of your question? Remember, I took the second part first. What was the first part?
The multifamily industry expanding on another level with the rental demand. And
Okay.
like with Class A apartments being so expensive in California, do you see that growing higher, basically?
So Kathleen, do you see the multifamily market continuing to expand because rents are continuing to increase? And what about Class A in particular?
I don't, you know what? I haven't done enough research on Class A to really give you that good of a read on it. Locally, I think if you have access to CoStar data, I think so if you are a commercial broker and you have access to CoStar data, I think that would be your best indication in the California market. If you're not a commercial broker, get with one who has access to CoStar data, but I am not transacting right now, so I don't have access to the CoStar data. And so I'm not so sure. I do believe, however, that at the low end, so I would be much more bullish on Class C rental real estate than Class A.
Okay, working class. All right, we're gonna ask this question from the Zoom, the last question, and we're gonna bring it to a close. So Alex, what's our question that you have?
So we got a question from the other Bill in our meeting, Bill Aguirre. Bill, go ahead and unmute yourself and ask your question.
Kathleen, given what's going on right now, interest rates probably going up 7 times this year, geopolitical concerns, inflation, going up at breakneck speed. I'll try to net it out this way. How do you see real estate in California? And my particular concerns are California and Florida, right? In terms of price and sales volume that make us want to invest in one or the other.
Well, I know Christina recorded the presentation, so you might want to go back and listen to it again once she posts the recording. But really, Bill, I don't think so. I unfortunately, I disagree with your premise. I don't think that the Fed is going to be able to raise rates 7 times this year. I think that the Fed is really in a tough spot. I don't think that they'll be able to raise rates more than 50 to 75 basis points without triggering a recession in the economy, which they will want to avoid. So I think that we're much more likely to have inflation run high than we are to have the Fed be able to raise rates, specifically because the government owes so much money that it would decimate our annual federal budget to raise rates much more than 75 basis points. So, so where do I think that that's going to go for transactions? Well, I think that we have a lot of cushion in the real estate market in that we still have a lot of excess demand chasing after very low inventory, and we're not building nearly enough units. So in Orange County, we typically have 6,000 units for sale, and we typically turn over 2,500 a month in Orange County. Right now, we only have 1,100 houses for sale, which means we can only do less than half of what our normal transaction volume is if we sold every single house. So I think that gives us a lot of room for rates to go up before it crashes the real estate market. Does that make sense?
Yes, it does. But
okay.
Can I summarize it this way? That in terms of value or price, you don't anticipate anything that will drop the price because of all these concerns, right? Interest rates, geopolitical concerns, and all that. And number two, just because there is a stark demand that supply does not meet, prices will remain steady and perhaps go higher in the coming year. Can we say that?
Yeah, I think so. I mean, I can't comment on every single geopolitical event that might occur. I mean, there's a lot of black swans, and things that we maybe not even anticipate that could happen. I am not looking for real estate values to crash in the short term. I'll just say that.
Great. Okay. Thank you so much.
Thank you, Bill. Kathleen, thank you so very, very much. Can we give her a hand, please, everybody?